Welcome to Trade with Conviction, the show where we cut through the noise on oil, freight, and everything in between and tell you what the market's actually doing. I'm your host, June Go. Very happy to have Abhishek and Jorge here today. Welcome, guys.
Hi June, hi Jorge.
Hello, guys.
All right. In the past week, we hit a high of $100 per barrel on ICE Brent, went to the lows of $85 per barrel within 3 working days, and back up to $93 per barrel at the time of this recording. Attacks and strikes, a period of quiet, but that is now broken. Abhishek, can you tell us about this roller coaster ride, starting with the escalation of the Houthi attacks on Saudi tankers and oil infrastructure?
Yeah, sure, June. So, a lot of development happened in the last couple of days and this week. In terms of development in Red Sea, especially from the Saudi side, we had seen 400 kbd Jizan refinery struck. The integrated gasification combined cycle, which we call IGCC unit, and tank farm was affected. Refinery expected to be down at least till mid-August. Repair timeline can be quite variable as the unit affected is not a simple one, and extent of damage is unknown. This is very important for distillates, and we will discuss later in our distillate section. Jazan exported around 200 kbd of refined products, and more than 50% of that is diesel, while naphtha accounts 30%. And typically, most of this naphtha heads to Asia. Regarding the Houthi maritime embargo on Saudi Arabia, there were attacks on a couple of vessels last week, and at least 10 vessels had to U-turn to avoid Bab al-Mandeb. This has seen visible crude loading drop from Yanbu. We have seen close to at least 30%. There was also a drone attack on Abqaq. Abqaq is Saudi Arabia's largest crude oil processing facility. It's not a refinery, but a key processing unit to stabilize the oil before it gets sent to export terminals or refineries. Back in 2019, this facility was also attacked, and it had caused a biggest single day jump in oil prices in decades. However, this time is different. When we saw those attacks happening, in fact, this time the oil prices dropped. I mean, this is what it is. And in Med, the CPC terminal resumed accepting crude from producers and loading tankers on July 27th. Shutdown was triggered by series of drone strikes on tanker and terminal infrastructure between 17th to 20th of July. And in terms of oil prices, as we had seen earlier, there was few days of calm, and then on Wednesday morning, Saudi Arabia and US have carried out strikes against Iran-backed militias in Iraq. Iran had also launched missile attacks at US forces in Jordan. Even today, we saw the reports of US launching strike on Iran, and as a result of which, we saw oil prices spiked again and above $90 per barrel. By the way, there is also OPEC Plus meet happening in August. What do we know so far, Jude?
The OPEC Plus meeting is scheduled for 2nd of August. Based on market reports, they are likely to pause output hikes after September. Sources say that the group will hold off on further monthly increases for the rest of 2026 as a sign of how unsettled the outlook is. But really, how much of this can truly impact the supply if production remains shut in or curtailed due to Strait of Hormuz closure and Bab al-Mandeb Strait also looking impassable? So I leave it to the market to decide. But let's talk about the Yanbu side of the story. It's been quite an interesting week over there. Let's start with Abhishek. How exactly will the Saudis reroute from Yanbu to global markets? How much time and cost will this add to a shipment to Asian markets?
Yeah, so Saudi exporters of crude and product will reroute via the northbound Suez Canal, but it adds significant time in transit. If we talk about transit time from Red Sea from Bab el Mandeb, it's roughly 20 days against 50 days via Suez Canal and then taking Cape of Good Hope if you have to go to Asia. And notably, the voyage time from the US to Asia is likewise around 50 days, meaning direct competition between AG and USGC exporters. Additional costs just from the freight for the northbound transit compared to southbound via the Bab el Mandeb are upward of $3 per barrel for Asia. And this is upfront cost, but there are other associated costs like working capital, which will be tied up for another 30 days when we take through Cape of Good Hope.
Volume-wise, how much can the Saudis reroute? They were exporting around 3.8 million barrels per day of crude and products through the Bab al-Mandeb, but it is doubtful that they can reroute all of this. In that case, will they prioritize crude or products?
Yeah, physically, it's likely that more crude will move through Suez Canal than products, mainly due to the loss of Jazan refinery capacity that is freeing up 400 kbd more crude to export relative to products. During 2023, 4.5 million barrels of crude and 4.3 of products were able to transit through the Suez Canal. And then we have the Suez Mediterranean pipeline, which has capacity for an additional 2.5 million barrels of crude.
So it sounds like we do have enough logistic capability to reroute. It's just the cost, the additional cost
Exactly, yeah.
into the market. Yeah. So how is this impacting tanker rates?
Yeah, of course, this has been translated into tanker rates. And looking at Suezmax rates, they have climbed since the initial re-escalation period, but they have plateaued since the pause of the US strikes on Iran. And dairy freight in general will go up because this adds 60 extra days for a return voyage, not including the Suez Mediterranean related days for a VL. So yeah, overall, this additional employment time will tighten vessel supply.
All right. I think I want to address some of the questions that my Twitter followers have been asking me. Why can't Asia just take the West African crudes, leave all the Saudi crudes into Europe? So on paper, you would think it's easy to just take in the lower sulfur West African or WAF crude versus a higher sulfur Saudi crude. But it's a much bigger quality issue than that. Asia is designed for Middle Eastern crudes, which are low in tonne and nitrogen. Tonne is a total acid number. That's a measure of how corrosive the crude is. As the older units in the refineries are built off carbon as a metallurgy, a higher tonne crude would corrode the units very quickly. There are of course some refineries that are built to withstand higher tonne, Reliance for example, where you have stainless steel metallurgy. For nitrogen, it's about catalyst activity. Higher nitrogen can kill catalyst activity faster in the hydrocracker and in the FCC. As a refinery, you want to keep the catalyst life long enough before the next plant turnaround. So all this results in Asia not able to absorb incrementally more West African crude than leave it all to Saudi grades to Europe. Okay, then maybe I'll switch my tune now. There's another crisis happening in the world, and that's on another waterway in Europe, the Rhine. Jorge, can you take us through that?
Yeah, it's all about prices at the moment. So we have this third one related to Rhine water levels in Northwest Europe. So the choke point in Kaub fell to 32 centimeters. This is the data from July 27, and it's forecasted to be below 20 centimeters by early August. So at this level, barge operations have no legal obligation to carry cargo, and the main impact would be on the petrochemical side. And we are already seeing it in Naphtha stocks in area. They have a surge, and also on the demand side in Germany, we have seen some operations having problems. So, for example, the force majeure of LyondellBasell, butadiene, and we also have Shell ethylene cracker that has also been offline since early July. On the other side, it's also a big impact on distillate due to the overall very bullish market that we are seeing globally in distillates. It has not been translated into any stocks movement. In fact, initial area stocks are at the lowest level since August 2020. And there is not a real alternative. The rail line that could be used to compensate the loss of volume going through the Rhine has been closed since December. So there is not like an alternative route for this at the moment.
All right. Thanks for that sharing for Europe. So we'll now focus to US. US is another situation on its own. I will share basically the EIA updates. We've got highest crude production in 5 years, lowest commercial crude stocks since 2018, lowest Cushing crude stocks since 2014, lowest SPR crude stocks since 1984, but the highest refinery utilization rate since 2018. Yet, we have the lowest gasoline stock in 5 years, the lowest diesel stock since 2022 seasonally. So any wonder why the US Gulf Coast 3-to-1 margin is at its highest ever recently. The last print was about $62 per barrel. For those who don't understand, this 3-to-1 is essentially for every 3 barrels of crude oil the refinery processes, it makes 2 barrels of gasoline and 1 barrel of distillate fuel as the typical gauge. So maybe it's a good time now to segue into the 2 barrels of gasoline on the gasoline market. Jorge?
Yep. So we keep seeing a very bullish gasoline market. If you look at global cracks and time spread, they keep climbing, and we are at new record highs, despite the rumor of a deal, and despite path 3 stocks have climbed during the last couple of weeks. So the situation remains extreme in the gasoline market. And as you say, yeah, we've seen some improvement in path 3 stocks, but overall the picture is really bullish from the stock side. And we are back to a stronger east-west level. It has recovered $9 per barrel for August levels. And east of Suez, well, this means that east of Suez is feeling again the bullish factor of the lack of AE supply. During a period, West was clearly the one leading the bullish trend for the last month. And right now we are seeing east of Suez catching the West on this uptrend. Then one of the key movements for summer is the TAR, so sending gasoline from ARA into Path 1. And right now it's closed in the prompt, but there is some workable windows according to our calculations. But for the end of September, when the summer driving season it will be over. So Europe still keeps a better landing premiums into South America. So this means that the US is protecting their barrels. They are not massively importing from ARA, but they are protecting their barrels to flow out of Path 3, even now that they have a wider balance with the increase in the Path 3 stocks. Then on Europe, we have seen a strong rebound in gas NAP. We have been talking about this for the last couple of weeks. Naphtha was very strong, but we thought that there could be a potential uptrend in gas NAP. We have seen it, and this has impacted E10 blend margin in Europe. They are now open. They have been closed for a while, and right now they are open. This means that the margin of going to the spot market, buying components, blend them locally in ARA, and sell them in the barge market makes a positive margin. And this is bearish for the EBOB market because more product is going to stay inland and less is going to be exported. So combining both views, the tighter stocks in Path 1 and this bearish factor in the EBOB market, I think the view is to see a potential upside in the TAR in paper, so more barrels can flow from ARA into the US.
Okay, thanks for that. Do we see the same picture for Naphtha?
No, it's kind of the opposite what we have seen during the last weeks. Well, there are many things in common, but in the paper market especially, we have seen the opposite. So with all the rumors of a potential de-escalation, we have seen a very strong correction in the paper market in Naphtha. But it has been just on the paper, time spreads and cracks, mainly in Europe and in Asia, which has a very strong correlation. We have seen this correction, but then the physical reality keeps showing a very tight market in the east of Suez. So we have seen a strong recovery in the physical premiums in the castives in Asia and also in Med. So right now, Asia has to increase their imports from Europe and from the US. And the first point where we have seen stronger markets is in the Mediterranean. So the FOB premiums are skyrocketing in the Med. And also the rise in the East-West in the paper has allowed these barrels to show positive margin. And right now we don't need a positive margin through the Red Sea, but we need a positive margin through the Cape of Good Hope. And we have seen this reflected in the spike in East-West and Asian castive. So the physical market is kind of pricing the fundamental that we are seeing despite the correction during the last days in the paper. Both AG corridors remain shut. So the structurally deficit stands, and we will see more and more European cargoes going through the Cape of Good Hope for September deliveries. Then from October onwards is another picture. What we saw during the first wave of the war was first all the indicators going to the sky, to the highest seasonal level in 10 years, and then demand destruction came. So that means lower naphtha demand, less need of imports from the West, and the market corrected. And this could be like the summary of our view at the moment. So everything is very tight, but from October, November onward, if the situation remains like this, we could see demand destruction hitting the market on a very small.
Okay. Sounds like a very dour picture there. Okay, but I guess we should move to distillate, which is the talk of the town, Abhishek. What's happening there?
Yeah, June. So there is no short of news headlines in the market, but there is real shortage of diesel in Europe, especially. Rotterdam still isn't seeing a clean US arb if you're talking about arbitrage. New York only works in the prompt window, while Houston shut both on MR and LR2 across most of the curve. Houston to Rotterdam is marginally closed in August second half, about $3 a ton or so, and it gets worse into September. Europe close enough to grab the odd prompt cargo, but not close enough for a sustained USGC barrels. As highlighted in freight analysis by our commodity owner Michael, TC14 has tightened hard. The USGC MR prompt list flipped from heavy to tight fast. More than 24 ships gone on subs. Owners pushing offer from world scale 305 to world scale 320. And this is not arb driven, it is supply scarcity, longer hauls, higher turn mile demand, and that freight spike just slammed the Houston, Europe diesel up shut again. Same with Sika Rotterdam, it's still not giving Europe a clean diesel signal. Northwest Europe stays mostly closed. The Med story is different though. The screens more constructive there. So West Coast India barrel can still work west of Suez, especially in Med, if the routing holds, because that arb is positive if the vessel takes a bubble Monday, and that's the catch. If owners gets cautious or insurance and freight climb further, the Cape route eats the economics fast. The Med arb looks open on paper. Whether it flows depend entirely on whether ships will run the Red Sea corridor or through a Cape of Good Hope.
Yeah, that's a good point. We are hearing that Jizan refinery could be out for a couple of weeks after the recent attack. And there are also reports that Russia may extend its diesel export ban. How are these two developments tying into the broader diesel fundamentals?
Yeah, so in Jazan is another risk, which is offline until mid of August. We don't know the exact nature of damage, but based on what we know so far, even on start, it may produce more fuel oil than clean product initially. That could mean Saudi holds diesel at home, and some Yanbu barrel can stay local instead of going export. So that's another supply loss from diesel side. On Russia, Russia is preparing to extend its diesel export ban through end of August. That keeps European replacement demand elevated for longer. And even an earlier lift, let's say mid-August, won't price in relief until actual Russian barrel shows up. But that's the thing, just the headline of ban lifting can release some pressure from the steep pricing we see in diesel. And recently, we have seen yesterday there was further drone attack on two of Russian refinery. So we still in a wait and watch mode what the government will do, because this is again based on market sources that the diesel ban will be extended until end of August, and if the supply situation improves, it can be lifted in mid of August. We'll have to wait and see what the official sources say at the end of the day.
All right, then how about Asia? What's happening here? And do you have any new trade ideas?
Yeah, so Singapore isn't getting a wave of supply either. Ulsan's mostly closed, Sika's deeply negative in prompt months. China August export looks lower than July. One caveat, there is one LR2 fixed from West Coast India to Singapore for early August. We see Asia remain supported, no doubt. Singapore distillate stocks retreated to a 3 week low, and that kind of backwardation should incentivize destocking. And but the move in Asian diesel prices has been way less extreme than what we have seen in European ones. Europe still has to outbid the East for end of summer diesel, especially Indian swing supply. In terms of trade ideas, we had recommended short on Hogo September couple of weeks back from when it was 35 CPG. For initial target of 30, it came to 30, then we still had continued with our short for a target of 27 initially and 25, and currently it is actually closer to 25, 26 CPG. I still think there is some room there because Europe still needs barrel and Hogo needs to correct further apart from the freight rate TC14. Yes, so we still see some room there in terms of going lower Hogo. I have one contra trade. It's a very risky one, but looking at what's happening in the East versus West is much tighter than the East, and with couple of cargoes as we see a fixture from West Coast India to Singapore gives me idea that there could be some sort of relief which can be happening for shorter time, with a big caveat that there is no further escalation and there more drone or missile attack in the region. Otherwise, if the current SEP spread on the Singapore is currently 9.5 fish, it used to be 10.5 couple of days back. When we look at the same time spread on the ice castle swap, it is at the all recent high, at all-time high. But on the Singapore side, it has dropped and now it has not crossed that 10.5 earlier. So based on that, I think I'm not saying there's a lot of availability on the Singapore side, but on a relative basis, we can see a small pullback on the Singapore time spread.
Okay, so much activity and ideas for diesel. Let's give some love to jet fuel. What's happening there?
Yeah, true brothers, but diesel getting all the love.
Yeah.
European jets looking softer than diesel in the prompt market. Heavy arrival from US, Dangote, India weighing on safe Northwest Europe diffs. The real concern is diesel, as we discussed earlier. Jet supply is enough to cover current holiday demand. And same in Asia, it mirrors the West. The drop in Singapore regrade shows a diesel tightening faster than jet. That regrade weakness has reopened East Asian jet arb into US West Coast, which should cap the recent run in LA jet premia. On the jet arb into Europe, Red Sea LR2 remains the main route still holding, while for West Coast India, both through Suez and even through the Cape of Good Hope arb is open. And it is important to track if those vessels are actually transiting Suez or not, given the heightened risk of Houthis in the Red Sea. Bottom line is jets weaker than diesel, and pressure builds further as European peak aviation demand fades late in August. But low stocks and Red Sea and Jazan risk mean the better trade is bearish jet versus diesel. I mean the regrade rather than outright jet short. Okay, so we have talked about a lot of clean product, the gasoline, naphtha, and distillate. So, what do you think about the crude and the physical market and the crude chew?
All right, my favorite topic. Well, physical markets are trying to grasp reality of delayed cargoes with no signs of full opening of Strait of Hormuz. We saw Murban premium soaring to as high as $26 premium against Dubai, but that settled down to around $10 per barrel basis. So just in case you guys don't know already, Murban and Oman are the only two Middle East crudes that can load from outside the Strait of Hormuz. Additionally, we saw ADNOC's 7th crude tender results. There was about at least 26 million barrels of crude awarded, mostly sold on delivered basis to buyers in China, India, Japan, and Vietnam. About 8 million barrels of this cargo can be delivered as early as August to Asia. What's interesting though is that DAS crude was sold on FOB basis for delivery to East Asia at Dubai premium less than 1, while we had Murban sold at Dubai plus 10. This is basically telling you that the premium differential people are willing to pay for cargo logistics outside the Strait of Hormuz. And then we look at the buying pattern of the players here in Asia. Koreans were the first to fix 2 VLCC loadings to load from CD Courier within 2 days of the Bab al-Mandeb blockade. India's MRPL for the first time asked suppliers to avoid both the Red Sea and Hormuz in a spot crude tender, a sign that refineries are now routing around 2 choke points at once rather than 1. We've got euros pricing into India discounting at $10 per barrel during the brief ceasefire, but is now back at near parity to Brent. So my question to the listeners, who's benefiting most from this crisis? On the WAF side, is coming up from very weak FOB levels. China is not still really buying these WAF barrels, and is therefore downright the cheapest barrel out there. TD20 rates are likely to rise to offset the competitiveness of the barrels. But again, beggars can't be choosers. And you might be asking me why TD20? That's because the Suez Max demand will increase because more cargoes will reroute out northbound from Yanbu to Asia. For WTI, the up to east for October arrival cargoes is open versus Murban, but the up signal in reality is less important now. What's more important for the buyers here is securing barrels. We even heard a Korean buyer purchasing 2 Aframax tankers WTI for early September arrival. Normally, this should come on VLCC basis.
And do you see anything exciting on the European side?
Last week, we had the whole shebang on CPC suspension that brought panic to the Brent market initially. Brent CFDs hit a high of about $11 per barrel against October futures, but that has quickly come down to about $3 to $4 per barrel now once the loadings resumed on Monday. So it's still there now, but it's a bit slower and delayed program. Aside from CPC, Libya's 80 KBD Alfil and Wafa oil field production has also been halted, but hey, no one's really bothering about such a small production outage nowadays.
Yeah, June. So as we mentioned earlier, there's no shortage of quick updates around the market and a lot of headlines impacting the oil prices. Could you do a quick take on fuel oil market where it is?
Okay, I'll start with high sulfur fuel oil. In line with all the escalations in the Middle East, the August 180 cracks against Dubai hit a high of $6 per barrel, but have since eased to $460 per barrel. Mind you, this is still a positive crack and the highest August crack we have seen from our 10-year history seasonal charts. We may see some weakness further with Jizan restarting and producing potentially more high sulfur fuel oil in August. On low sulfur fuel oil side, I made a call last week that VLSFO is tight, and with Sing 0.5 crack against Brent solidly above $22 per barrel, it marks the difficulty refineries are facing to produce more VLSFO in the market when crude supplies are now not guaranteed. We still have, of course, power gen demand quite strong in the Middle East. The crack is now at $23 per barrel, and I personally still think there's room to go up because the crude shortfall is real as we head into September processing and the medium crude resupply options are getting limited in Asia. By the way, we are having a fuel oil webinar on Tuesday, 2:30 p.m. Singapore time, 7:30 a.m. UK time. The sign up link for the webinar is in our Sparta website, www.spartacommodities.com/market outlook. Okay, I think we have it for this week. Thanks, Jorge, and thanks, Abhishek. For the rest of the listeners, stay sharp, stay sane, and as always, trade with conviction. See you all next week. Thanks,
Thank you.
guys.
Thank you.